Now let's get to our next guest, and that's David Barse, who is the founder and CEO of XOUT Capital. Welcome back to the show, David. You know, I took a look at some of your notes and your product that you have out there, the large cap ETF, XOUT is a ticker symbol here. It's done really well. It's outperformed the overall market by a hefty pace. When you look at this, you know, this type of market that we're in, where a lot of people say it's overvalued, but then you look at the growth numbers moving forward. When you look at you know, names that you want to put into this large cap ETF, do you look for quality, or do you look ahead more of what's going to be there in the next couple of years?
Yeah, it's a combination of a number of factors. And Tom, thanks for having me and stepping in for my favorite host. Unfortunately, she couldn't be here today. But I have devised a formula, if you will, a model for thinking about what is one of the most forward-facing risks that all investors have, which is technological disruption. And you can use sort of traditional factor analysis words like quality or momentum or growth. This is a smarter approach than what those approaches have been in the past. We dig into the fundamentals of every company in our constituent base, and we derive from that certain fundamental economic measurements that weight against all the other 499 in our constituent and score them. So it's thinking about technological disruption using metrics on revenue calculation, on how well a company is doing with its labor force, on what a company's doing about buying back its own stock, investing in its business, how it's investing in research and development. What's the management team doing to address technological disruption? So we amalgamate those factors to give a company a score. And the bottom 250 scores of the largest 500 U.S. market cap securities get eliminated, or in our parlance, X'd out. And that simple, intuitive approach to addressing this important forward-facing risk is what's garnered, quite frankly, I'm very proud of the performance we've developed. It's even exceeded my own expectations.
Yeah, and I think if you take a look at this, what intrigues me about a product like this, David, is the fact that you're not shorting stocks, right? You're just looking for the best names based on your proprietary information, and I think that's really important. As people are going to continue to search for yield with the overall market at or near record highs, valuations growing, getting stretched a little bit, this active management type of ETF is probably the new wave, don't you think, of investing, not in a passive sense, but not a fully passive sense, correct?
Yeah, look, I've called it smarter beta, smarter because we're using this actively conceived rule. It's a rules-based approach. We only rebalance quarterly, but it is one in which we've taken these fundamental factors that are unearthing what is in effect long-term secular decline in certain of these companies. And there was a lot in what you said, but let's touch on a few of those points. Short selling. This is sort of a scalable short selling model. We're just not owning companies. And boy, have we just learned a valuable lesson about the risks associated with shorting a security, right? So we've been saying that from the beginning. Short selling isn't a great strategy. There are very few people who actually do it effectively. And now those who are considered the best are out of the business, or at least claiming to be out of the business. So let's stick away from that kind of risk. Just don't own the companies. And then on the, the sort of the new wave, if you will. So look, one of the most famed value investors in the market, if not the most famed, just added 2 new securities to his portfolio, right? Verizon and Chevron. Those are perennial X-outers. Why? They're in long-term secular decline. Some of the announcements that companies have made about what their long-term future and growth is, sort of scratch your head and wonder what they're doing, what Berkshire's doing, but they're doing it for what? The dividend yield? This is a growth strategy, right? We're trying to give you a better mousetrap for getting growth in a diversified way without taking on additional risk.
Yeah, I like that thought there, where just because it pays a dividend and you know, they make money, but they're not a growth company and their outlook isn't that good, so you X them out. I like that. But real quick, David, before I let you go, I kind of wanted to just touch on, you've got this great product out there in this ETF, but you're also looking in the mid-cap space. Tell me a little bit about that.
Yeah, so look, our approach is again, intuitive and simple, easy for you to explain to folks, but it's also applicable to other indexes. We are taking advantage of a fundamental flaw in indexing. Indexing, you buy everything in an index. In our case, with our smarter approach, we're able to X out or exclude those companies, I said, that are being impacted by this risk. Mid caps is our next target. Stay tuned for the launch of that next index, but that's coming, and we think we can also exploit what we think is a great growth. Look what's happened in large caps. It's been phenomenal in the last 18 months, but I think mid-cap space is a next great target for us, and we're going to bring a product to the market that will help investors not have to buy everything in that mid-cap index just because some other large index company has decided that these are the companies that need to be in that index.
Now, we'll look forward to that, David. Thank you so much for joining us. And I promise you, next time that you're on, your favorite guest host or your favorite host, Nicole, will be back. I promise you that.
All right, that's great to hear. Thank you.
Thanks for joining us. He's the founder and CEO of XOUT Capital.